Why is the LTV ratio important for a HELOC? Imagine you're thinking about tapping into your home's equity to fund a big project or cover some expenses. Before you do, there's a key number lenders look at called the loan-to-value ratio. This number helps them decide how risky your loan might be. The loan-to-value ratio is found by dividing the total amount you owe on your home, including your mortgage and any other loans, by what your home is worth today. For example, if your house is worth $300,000 and you owe $150,000 on your mortgage, your loan-to-value ratio is 50%. If you then want a home equity line of credit, or HELOC, the total of your mortgage plus the new HELOC can't usually go beyond around 80% of your home's value. That means if your house is worth $300,000, you could borrow up to about $240,000 in total. Lenders use this ratio to see how much risk they are taking. A higher ratio means more risk because, if you can't pay back, they might not recover all their money. So they tend to set a maximum ratio to protect themselves. The loan-to-value ratio also impacts how much you can borrow and the interest rate you'll get. If your ratio is lower, meaning you owe less compared to your home's value, you might get a bigger credit line and a lower interest rate. That makes borrowing cheaper and easier. Plus, your eligibility for a HELOC depends on this ratio. If your ratio is too high, the lender might say no or give you less favorable terms. This is especially helpful if you're planning to use the HELOC for home improvements, debt consolidation, or emergencies. For home improvements, a good loan-to-value ratio can mean more funds at a better rate, making your renovation plans easier. When consolidating debt, a lower ratio can help you qualify for a larger line of credit with lower interest rates than credit cards. And if you want a backup fund for emergencies, keeping your ratio manageable ensures you can access the money when needed without overextending yourself. So, understanding your loan-to-value ratio is a smart move. It helps you see how much you can borrow, what interest you'll pay, and whether you'll qualify for a HELOC at all. Banks and credit unions relying on this number to balance their risk while giving you flexible options to use your home's equity wisely.